can see that this fall in sterling dwarfs all others ever since the pound has been allowed to float freely, considerably greater even than the infamous Black Wednesday in 1992, when George Soros infamously bet that the pound would be forced to exit the European exchange rate mechanism. To look at it another way, this is the exchange rate of sterling against the dollar going back to the Plaza Accord of 1985, when a group of governments and central banks got together and agreed to take measures to deliberately weaken the dollar. Since then, the pound has never managed to fall significantly below 140. It has done so now, and it has done so even though earlier in the evening it had actually hit $1.50 for the first time this year. That leads to, I think, another very critical question which we will all have to answer, which is how the markets got this so wrong. They completely misjudged the mood of the British people. Now, to put that in one fairly straightforward framework, this is the odds shown by the oddschecker.com website. It's a compilation of odds from different betting sites. And you can see that heading into the result, there seemed to be barely even a 10% chance that Britain would vote to leave. Remarkable confidence, given that polls of polls were still never showing much more than a 1 percentage point advantage for Remain. Now, the first big alteration, the first big sign that perhaps they had all got this wrong, came from Sunderland, the second city to announce its results in the UK. It voted overwhelmingly to leave. That was a surprise, and even at that point, the fall that you then saw in sterling was greater than we saw on Black Wednesday in 1992. After that, you saw some stabilization. The results gave some hope in the case of some London constituencies for the Remain camp, but the trend remained clear. And the final nail in the coffin, at which point news organisations were prepared to call the referendum for leave, came when Birmingham, Britain's second largest city, voted very much against expectation to leave. It had been expected to be a bastion for those who wanted to remain. As you can see, that led to the odds moving all the way up to virtual 100% that Britain would exit. One instant question is, how did the markets manage to be so wrong? It appears that many hedge funds, in particular many macro funds, have had a very bad year so far. They were very anxious to get ahead of events. Many of them had commissioned their own polls, commissioned their own exit polls, and perhaps very naively, very foolishly, placed a big bet that that Britain was going to remain. Effectively, sterling and various other measures were already priced for 100% certainty of Britain remaining before the polls closed. Now, that leads to a very great risk that we could see even more of a financial accident that we already knew we were likely to see as trading resumes in Britain and Europe in a few hours from when we're recording this. If we take a look at what's happened already in Japan, this is what happened to the Nikkei 225 in the last few hours. You can see as the results became clear, a very sharp fall in Japanese stocks. Plainly, Japanese stocks are going to be far less affected by this than European or UK stocks. We can take it as a given that stock markets there are going to be under very intense pressure. Liquidity is going to be under very intense pressure. Many hedge funds, obviously, are sitting on severe losses. Perhaps the most significant, most important market to watch now is the US Treasury market. If we take a look at this chart, this is 10-year Treasury yields going back over the last 5 years. There was a low, a post-war low for 10-year Treasuries set back in 2012, which many people thought was going to hold. It still is holding. You can see that there has been a flood of haven demand, a move into Treasuries in the last few hours, but the yield is still holding above that low. It's very important that it continues to do so. If it doesn't, that would obviously be a sign of growing panic It's also something that central banks are unlikely to tolerate, and that is perhaps the single most urgent question. We're used to asking questions about central banks. We're used to relying on central banks in markets. Presumably, they cannot possibly allow a major currency to collapse in the way that sterling has just done and do nothing about it. Presumably, we are going to get some coordinated action from central banks in the next few hours. Just what it is becomes a critical question. As for Britain, over the days, weeks and months that come, there are many, many more questions. But perhaps the one wonderful thing to say out of all of this, the people have spoken. They have said things that the establishment didn't want to hear, that markets didn't want to hear. The people had been warned that you would get this kind of reaction from financial markets, this kind of a risk of crisis. They decided it was worth taking that risk, paying that price. We will see now over the weeks and months that come whether that price turns out to be justified.